So hello everyone, this is our last chapter and last discussion of PowerPoint slides for S corporations as we wrap up our discussion of business taxation. So some things that make S corporations unique: they have to elect this status. You cannot become an S corporation by accident. You have to elect that. You have to file a 2553 form that says that you are going to be an S corporation. Otherwise, when you become a corporation, the default is C corporation. To qualify as an S corporation, you have to reach all four of those areas. You can't shareholders you can't have a corporation own stock in an S corporation. So it's limited as to who and how many, and there only can be one class of stock. You can have stock that votes and other stock that does not vote, and that will not create a second class of stock. Now, 100 shareholders is high already, but it's even higher because they really made this loose in the sense that every family member counts as one shareholder. And that definition of a family member is even more expansive. 6 generations going each direction is a family. So woman or 3 children, 5 grandchildren, and 6 great-grandchildren are all family members. And if they all own stock, that would only count as one. So you can see where in the families, it's really going to be hard to exceed the 100 shareholder limit. So it's pretty high and doesn't get disqualify too many folks. But obviously, you couldn't be publicly traded and be an S corporation because by definition, you have to have enough shares to trade on the stock exchange. Everybody has to vote to become an S corporation. Everybody has to sign the documents saying they want to be an S corporation. Any one person won't sign, you can't do it. Has to happen in the first 2.5 months. It'll count for this year. So for 2019, for instance, it would have to happen. You would have to elect in January, February, or half of March. If not, then it's going to be go on into the next year. So if you make the election in May, it will count for 2020. You do this on Form 2553. To stop being an election, you only need over half to revoke the election. And again, that's a separate process. There's not an actual form for that, but it is you have to send in a letter to the IRS revoking your S election. You could become no longer S if you violate some of the rules. If you screw up and have a second class of stock, or you allow a shareholder that is a corporation, or if you used to be a C corporation and have lots of passive investment income. Any of those will cause your S election to be terminated because of the violation of the laws. And from that date that is the case, then you become a C corporation again. So that's what happens. So you can voluntarily choose to and actually choose the date you want it to happen, or it happens on the day that you violate the rules. Usually you're going to have a calendar year, and so you're going to be the same as your majority shareholders. Because you're not having corporations as shareholders, you don't have as much variability in tax years as you do with partnerships. All right, but you can, if you can elect a natural business year, if you have a lot of business at the Christmas time, you can not do a calendar year, but as long as it doesn't call deferral more than 3 months, you go up to September. Everything passes through the same way as a partnership, very much the same way. There is ordinary income, the regular business income, and then there are all the separately stated items, just like a partnership. The list looks familiar, same idea, passes through so that each of the shareholders can report them on their 1040 form as appropriate. All right, so in that way, very much the same as a partnership. It files a different form, 1120S, has a Schedule K where you list all the items for the whole corporation, then K1s that distribute it to the shareholders. 2.5 months after close, that's exactly the same date as a partnership, and 6 months extension the same as a partnership. If you do that. So the dates now for S corporation and partnerships are the same. That didn't used to be the case. Now they're the same. You only have to remember one date for those. However, they are different than a C corporation, which has 3.5 months. Now, while a partnership has some flexibility on how it allocates items of income and expense, the S corporation does not. Everything is allocated the same way on a per share per day basis. So you literally take the number of days that you own the shares, multiply it all out so that you can figure out exactly the part of it that belongs to each shareholder. So if you own 50% of the shares for 30% of the year, and then you own 60% for the other 70%, you would literally break it down by day, multiply those percentages, and figure out how much should be allocated to each shareholder that way. K1 looks an awful lot the same as a K1 for 1065. Usually less of the information down here because shareholders cannot include the debts of the S corporation as part of their basis. But the separately stated items are here, the ordinary income at the top in line 1. So 7% of shares, S corporation reports 55,000 and 2,000 charitable contribution. So the Schedule K will show all 55 and the 2,000, but Morgan's K1 will show 10%, only the 5,500 and 200. She's going to put the 5,500 on a Schedule E. So partnerships and S corporation, when you get a K1, that income that's shown on the K1 goes on the Schedule E for the partner or the shareholder, page 2. The 200 is separately stated and goes on Schedule A, just like any other charitable contribution. 20% for the days, you multiply by the number of days you owned it, okay? So it can get kind of complicated, but as long as you think it through, it's not too bad. And this only applies if there was a change during the year. Okay, in this case, he owned 20% for 248 out of 365 days. The rest of the year he owned 0 because he sold his shares. You can deduct losses. They flow through to the shareholder up to the amount of your basis in the stock. If you can't use them this year, they carry forward till you have enough basis as far, as long as you're still living. You start out with your initial basis, what you paid for the stock or what you exchanged for the stock, and then it goes up by ordinary income, changes by separately stated items. Any more money you put into the S Corp and any distributions make it go down. So that sounds an awful lot like what we did with partnerships as well. But this is the important difference. Do not increase your basis like we talked about. Okay. lower than 100%, beginning is 15,000. S corporation had lost of 20,000. Because the stock is only 15, she can only deduct 15,000 of the loss, carries over the other 5,000. She'll have to increase her basis in a future year to use that extra loss. Or if she has a income pass through in the next year, she can use it to offset that. Distributions are generally tax-free as long as there is AAA or retained earnings, you may say. Okay, it's a little more technical than just retained earnings, but in any undistributed items, it can be negative. However, you can't reduce it below zero from a distribution. Okay, so AA can be negative because of losses, even though they may not be deductible, but the balance can only go zero because of losses, not because of distributions. Distributions in excess of AAA depends on if it was a C corporation before. Most S corporations were never C corporations today. But if they were and changed to an S corporation, then if there's any retained earnings left over from when it was a C corporation, then that extra distribution comes out as amount from that EMP, that return of capital. Okay. Well, if it's distribution is out of earnings and profits, it's an actual taxable dividend, and then treated as a return of capital. So we elect a S corporation. They had $5,000 of EMP, has 20,000 basis in stock. Ordinary income is 12,000, no distributions. Okay, reports 12,000 on his tax return. That passes through on his K1, increases his basis to 32,000. All right, the AA balance is 12,000. Ordinary income 15, distributes 18, so more than that income. Balance increases by the 15, reports it on his income taxes, his basis in DG increases by 15. Okay, the 18,000 is tax-free because it comes out of AAA, and his new AAA balance is 9,000. His basis becomes 29,000 because reduced by the distribution. Started at 32, increased by the income, reduced by the distribution. We go on to the next year. The ordinary loss reduces the AAA down to 2,200 and his basis by 6,800 down to 22,200. The distribution is 2,200 up to the amount of the AAA is tax-free. The next 5,000 reduces earnings profits. Remember, we had earnings profits from back when we were a C corporation, and that's dividends. And then the rest is a tax-free return of capital and reduces the basis down to 21,000. So it's a return of money you already put in is how it's treated. Never recognize the loss in distribution of property, but if you distribute appreciated property, it is a gain. So it's as if you sold it and then distributed the cash. Okay. Fair value of the property reduces AAA and the shareholder's basis. And that fair market value then turns and becomes the basis for that shareholder in that property. Sold shareholder, tribute land, it's worth 50, basis is 14. So there's quite a gain here in this land. IDG recognizes that gain. That's the corporation. Puts it on their corporation tax return. It flows through to ARENA on her Schedule K1. If there were more than one shareholder, it would flow through to multiple shareholders. That increases her basis in IGG and the AAA balance. $50,000 is the fair market value. That then is the amount of the distribution. The AAA goes down by 50,000 and her basis goes down by 50,000, and the 50,000 becomes her basis in that property that was distributed. Okay? In this case, there was a basis in land was 65, it's only worth 50. All right, so it's distributed at fair market value. All right, reduced both AAA and the basis by the 50,000, the fair market value. The basis in this case becomes irrelevant because there's no loss that can be distributed or recognized when there's a decline in value. So it goes one way: recognize the gain, but not the loss on distribution of property. Of course, if it's cash, you don't have to worry about that. If you're distributing cash, then obviously it doesn't go up or down in value like land might.